Is another part. And look at that, I hit the wrong key. It says 53-week MBA. It should say 52-week. No prizes for guessing what was happening there. For those of you who do not know me, I've been around the track a few times, 30 plus years, C-suite executive, Southeast Asia, here in Australia, across 12 different industries. I've won awards, I've done all that sort of stuff, but all of which is just said to let you know you're in good hands. Again, for those of you who are new, there is not a lot of BS and blah, blah, blah with my stuff. The stuff we've got is stuff that you can take away and start using. In fact, there is so much information. Often it feels like drinking from a fire hose, but this is a presentation, not a workshop. So the idea is take notes and please, for heaven's sake, ask questions at the end. There's nothing worse than doing one of these, getting to the end and everyone just sits there and says nothing. I'd like some feedback, even if you said it was crap. That's fine. I'd just like to hear from you. So time's short. We're going to get going. Today is about building a no BS guide to a 13-week cash flow projection. Sounds really, and those of you know me, I don't often delve deep into the numbers, but you need to look at that. So even if your books are behind, your VAS is behind, even if you hate spreadsheets, and I've got to tell you quite frankly, I loathe spreadsheets. And if your idea of financial planning is just checking your bank balance every day, this is definitely for you. This is a tool that every business should have. 13-week cash flow projection. And let's be honest, I've worked with hundreds of business owners over the last 12 or so years, and 30 years before that, I've worked in quite a few corporates. I've worked with smart people, I've worked with experienced people, I've worked with people running $2 million, $5 million, or even $50 million businesses. And almost every single one of them at some stage has been flying financially blind. They check the bank every morning like it's a weather report. The money's there, fantastic. The money's not there, oh my God. The world's ending. I need to go and have a warm bath with razor blades. Here's the problem. The approach is just to check your bank account. It tells you where you are, but it doesn't tell you anything about where you're going. You need to understand this. Cash flow problems is the number one reason why businesses fail, even profitable ones. It's not a lack of revenue, but really it's a lack of visibility into when and where the money moves. That's why a 13-week cash flow projection is so important. It's not complicated. It's not reserved for chief financial officers, accountants, or big corporates or anything like that. It's a tool that every business person should use. And, you know, it doesn't require a perfectly organized set of books either. What it does require is probably about 90 minutes of work to set it up, and then 15 minutes a week afterwards to keep on top of it. So what is a 13-week cash flow projection? Simply put, it's a week-by-week snapshot of the money coming in and going out of your business over the next 13 weeks, which is roughly a quarter of the year. You know, think of it like a financial GPS. It's not just where am I right now, but where am I headed, and am I going to run out of charge money, cash, before I get to where I want to get to? Why 13 weeks? Because it's close enough to be accurate, it's long enough to be useful, and it's short enough that you'll actually use it. 12 months cash flow projections are really an out-and-out guess, whereas 13 weeks gives you a plan. So most business owners skip this, and it costs them. Most business owners skip doing cash flow projections because they assume it's too complicated, or their books are too far behind, or they don't have time. I get it. You're running operations, managing your team, doing marketing, handling clients, putting out fires, sitting down with spreadsheets sounds about as appealing as having root canal with a dentist. But here's the reality. If you don't have a cash flow projection, it's like driving across the country without checking your Tesla's charge gauge. You might make it, you might not, you might end up stranded somewhere. The businesses that I work with that are struggling most aren't usually the ones with the lowest revenue. They're often the ones who've got the least visibility over their finances. So, how do you build your 13-week cash flow projection? The good news is you don't need a finance degree. You don't need a perfect miles file or a zero account. You don't even need a full-time bookkeeper to do this, although just quietly, if you've got a bookkeeper or you've got a decent accountant, one who's not a historian, they should actually be providing this to you on a monthly basis. What you do need is a spreadsheet, some honest estimates, and about 90 minutes of your time. So step one, quite simple, open a spreadsheet, Google Sheets, Excel, whatever, it doesn't matter. Create 13 columns across the top, one for each week. And down the left-hand side, create 4 sections. One for cash in, one for cash out, one for the difference, which is your net position, and one for your SAN, which I'll explain later. And that's the entire structure you need on this single spreadsheet. And it looks like this. quite simply. So you have the weeks running across the top, and down the side you've got your cash flow. I'll explain these extra lines in a moment, but you've got cash in, cash out, the net, and the SAN, which we'll get to shortly. Next, second step is to open your cash flow projection with your current bank balance. If you've got multiple accounts, add them up. This is the starting point. Don't round up your numbers. Don't fudge it. This plan will only be as good as the baseline you make it from. So in this example, the entire cash at bank, oops, let's go back, is 18 grand. That's where we start. That's our very first number we put in. How much cash we've got in bank today when we're starting this projection. Step 3, project your cash inflows. This is what you'd expect to receive each week. It should include things like outstanding invoices that are already sent, they're due. So if you've got someone who's due to pay you by Wednesday this week, you should include that. Recurring revenue, retainers if you get those, subscription payments from clients if you've got those, pending deals you're confident are going to close this week, any other deposits you're expecting. These are the things you need to be adding in there. You know, if your books are behind, then go and pull your last 90 days of bank statements and look at what actually came in each week over the 90 days and use that as a baseline. And then you can adjust those figures for anything you think's different now. Look, it's not perfect, but it's going to be real for you. So it looks like this. So in this example, we've got our cash at bank, which we spoke about. We've got $7,000 in sales expected. We've got 500 in retainers, 300 subscriptions, 3 grand in pending deals, 200. So we're expecting this week, week 1, to bring in 29 grand. It'd be a nice week, wouldn't it? But nonetheless, for the example, that's what we're doing with. Step 4, project your cash outflows. In other words, what it costs you to operate. Think in terms of the payroll, whether you've got staff or not, but you must include what you pay yourself. Think about rental mortgage payments if you happen to own your office thing, because we need to keep personal and business separate. So mortgage in this case means your business premises. Think about vendor and supply payments, line of credit payments, business car payments, software subscriptions, recurring services you might have like accountants and bookkeepers. Although if they're good, you wouldn't be doing this, they'd be doing it for you. You know, your estimated quarterly taxes broken down with everything else that you know is coming that you will have to pay out. Now, again, if you're behind on your books, same move as before. Grab your bank statements for the last 90 days and go over what money went out in the last 90 days. Look, it's not perfect, but it'll keep you honest. And that means this form now looks like this. So money out, there's rent, there's utilities, there's payroll, software subscriptions, some loans, money being put aside for BAS, support services, supply 9,500 is what we're expecting to have to spend. Step 5 is calculate your net cash position each week. Well, that's really simple. You subtract what you're spending by sending out your outflows from your inflows, and that gives you your ending balance. The ending balance is what you use to start next week's starting balance. And you do this again and again over the 13 weeks. And that means you've now got a cash flow projection. So what that looks like is we get down here, right? We've got 29 grand coming in revenue. We've got 9,500 going out in costs. So that would leave us with $19,500 as our net position. So that net position is what we start off the next week with up the top there. And once we've done that net week, we would work our way down. So you can see here the net position for week 2 is 20,900. That's what we start week 3. End of week 3, we've got 20,200. That's what we start week 4, and so on and so forth. This is how you work it through. Now, all these figures here are basically what we think are going to be coming in. You'll see there's variances. We'll talk about them in a minute. Step 6 on your cash flow projection is to find danger zones. When you set up your 13 weeks, and I'll talk about keeping it real shortly, but when you scan your 13 weeks, if it starts going negative, if you start losing money, ask where it is and then figure out what it is, what's causing that. If it goes your minimum comfort level, if say you think, if I'm making 5 grand a week, I'm comfortable with that, but gee, I'm projecting to only make 3,500 that week, then figure out why, right? Those weeks where your balance either goes negative or it goes below where you're comfortable, they're your danger zones. And the idea of doing this projection is you'll get some idea of when they're coming up, which means if you know them ahead of time, you can actually avoid going into crisis mode. You can do something about them. Look, senior danger zone advice lets you do a couple of things. Make that extra phone call, chase up that late payment, get on top of that supplier, cancel a service maybe. It enables you to take action. If you wait till the morning where you wake up and you look in the bank account and go, oh my God, the bank account's low, you're scrabbling and you're in crisis mode. That doesn't work well at all. So we'll talk about SANS in a moment, but you can see there's a bit of red there, but the red shouldn't scare you because of what it's tied to. But up here, you can see week 10 and week 11, we're starting off with negatives because the previous week we lost money. So if I've got this as a projection and I'm back here in week 1 or week 3, and I can go, gee, week 9 and 10 are looking tough because I know that's when some subscriptions end or some clients go overseas, or I've got to pay staff bonuses, whatever the reasons are. If I identify what the reasons are, I can start taking action back here to turn those into positives. Doesn't meet your SAN. SAN stands for your sleep at night number. It's not something that your accountant will teach you. It's something I work with all my clients. An ideal SAN is to have 3 months operating costs tucked aside in a bank account that you're actually not touching. It will take most small business owners anything up to 4 years to build that buffer, but it's important. I've got clients who've got 6 months, 9 months, and even one who's got 12 months operating set aside. But again, it's all taken them a number of years to do them. Now, you might decide it's 3 months, you might decide 1 month's operating. If it's 15 grand 1 month, you might decide 15 grand. Or you might say, if I've got 5 grand tucked aside, I can sleep well at night. It's entirely up to you to choose the number. On the spreadsheets, I've used 3 months operating, which is roughly 90K. But if you're under your sleep at night number, whether it's based on 3 months operating costs or a number you decide you're comfortable with, you've got to figure out, how do I increase my income? Or how do I reduce my costs? Because quite frankly, they're the only 2 actions you've got to affect them. So your SAN can look like this. You can see down here, sleep at night number. We know that on average, we're going to be bringing in about 30 grand. So I've just said 30 grand by 3 months is 90 grand revenue. Of course, the operating cost is 9,500. So really 3 times that is only 30 grand. So the sleep at night number could be 30 grand, not 90 grand here, which would mean some months it would be positive and other months you'd be behind. The only reason you track your SAN number is once you've decided it, is to see just how you're going. And this is a much better measure than trying to check your bank account every single day. With this tool, you need to update it weekly. Yep, every single week. It's not a build once and forget it tool. It's not shelf furniture. It's not a file you create in Excel and save and leave in the documents folder until you suddenly remember it in 14 months' time. This is something you should bring out. Pick a day. My clients, I normally suggest it's a Friday afternoon or maybe part of their Sunday 45-minute planning for the following week. And you spend 15 minutes just to update what money actually came in, what money actually was paid out for this week. So the numbers in that column for this week actually reflect reality, and they may spill forward from there. You can adjust your future weeks on what you know. You might find out that the deal that you were expecting to land next week is not going to land for 3 weeks. You might find out that suddenly you've got 6 new subscribers coming on that you didn't expect. Whatever reality happens, you use to update this form in the coming weeks as well. And the more consistently you update it, the more accurate it is. And that means you don't fly blind. And here's a couple of tips. Be conservative on how much revenue you're generating. All right. Clients pay late, deals slip, they move forward, subscribers churn off. So be conservative. All right. And plan for it. So if your expectation is I'm going to bring in 10 grand, maybe you should plan for 9 just to be a little bit careful. Be honest about your costs. Maybe there's a cost you've been avoiding paying. Put it in. All right. The truth doesn't get better when you ignore it. It just bites you in the ass that much harder when it arrives. A couple more tips. Separate your business and personal finances. I made this point before. If they're still mixed, this exercise will make that problem very obvious very fast. You need to have separate operating accounts. There should be an account for your non-work payments, and when you pay yourself each week or month or however often you pay yourself, you should take your pay and put it into that account and then draw down all your personal expenses from that account and keep them separate. The waters get too muddied and it's very, very hard to decide what belongs where if you're paying everything out of the one account. The tax department love it because you miss stuff, or they're able to find things that you're claiming as a business expense you shouldn't have. It's much better to keep them clear. Don't wait to have a perfect set of books, all right? Messy books beat having no books at all. Use what you have. Label your estimates clearly. So if you're estimating, I'm going to bring $10,000 in 3 weeks' time, make sure you asterisk or make a note to yourself to check up on that is going to happen, all right? And then start refining. The idea is to create this first with some forward projection and ideas, and then each week you put in what's actually happened and you adjust moving forward based on what you find out or on what effect this week's actual numbers have had. The bottom line is you started your business to build something, whether it was freedom, a legacy for your kids, more income, have impact, or even just a better lifestyle. None of that's going to happen if you're constantly surprised when there's cash crunches happening. None of it's going to happen if you're scrambling to make payments, behind on your BAS, or making decisions based on hope instead of data. The best decisions come from data. This 13-week cash flow projection is not glamorous. It's not the exciting part of running a business, but you know what? It's the thing that keeps the exciting parts of the business alive. It's one of the foundational tools I build with clients, not all clients, because some clients already have them. And I don't build it because I love spreadsheets, but I build it because clarity is second only to structure and creating freedom inside your business. And after all, freedom is the whole point. So look, after today, apply what you've learned, create a 13-week cash flow projection, or get your accountant to do one, or get your bookkeeper to do one for you if you want. Just don't stick your head in the sand and say, I don't need that, because you do. Every single business on the planet needs a cash flow projection, because you live and die on how much cash you have coming in. There are lots of businesses that are incredibly profitable on paper, but they have no cash in the bank and they go out backwards. They go broke because they have no liquidity. Cash flow equals liquidity, and that's what keeps you alive and out of trouble. All right. If you need a hand, help is available. Let's have a chat. My link is already in the chat box. I'll put it in again if you like, but or you can scan the QR code quickly. If you're watching this on the replay, same thing. Just scan the QR code. It will take you to my calendar. And lastly, famously, has anyone got any questions for me? Thank you.
That was thanks again,
great,
Geoff.
Geoff. Thank you.
I'll just stop the recording and then we'll get into the questions. And there we go.